We have done, I think 3 webinars till now with Samit Vartak, and all those webinars have been quite insightful. I have been hearing about Satish Kothari from Samit Vartak, and this is the first webinar with you, Satish. So, I would say formal welcome to you on our platform, PMS AIF World.
Hi, Kamal, and thanks for giving me an opportunity. I hope the session is insightful to you and the entire audience at large. So, yeah.
No, surely we have seen, a lot of fund managers, specifically Samit, talking a lot about finding and spotting multi-baggers early, especially in the small cap space and mid cap space. And it is, I would say, I'm curious to know how SageOne is now wanting to deliver equally good returns or outperformance over the respective benchmark with large cap and mid cap focus strategy. And
So,
absolutely, this is one offering which has a space for a lot of clients in their portfolios for at least the new share of wallet that we get from our existing clients. And hence, I'm equally keen to learn and understand from you over this webinar. And that's why we kept the topic very simple, straightforward, and to the point that yes, we and our clients are looking for alpha. And if you can deliver alpha over the respective benchmark in large and mid cap portfolio, absolutely we are kind of inclined towards it. So over to you, Satish. Just to give everyone a perspective, Satish brings with him around 2 years of experience. He is a CFA and has been working with SageOne for last almost 2 years. He's a fund manager for their large and mid cap strategy. Before SageOne, Satish has worked with Nuvama, ICICI Securities, and JP Morgan. And over to you, Satish. You can introduce yourself, maybe in more detailed way from here onwards and take it up. I'm just, sharing the screen and giving you access to the presentation that you have kind of
sure.
for today. All the best to you.
Thank you. Thank you, Kamal, and hi, everyone. It's my pleasure to take you through SageOne Large and Mid Cap Fund. So, I'll start the presentation. First of all, about SageOne, I think SageOne was started by Samit Vartan. He's quite well known. In 2012, uh, we are a bottoms up stock. We follow bottoms up stock approach in terms of portfolio creation. We have around 100 years of combined experience, and currently we are managing 7,000 crore plus AUM across 3 strategies. First one is SageOne Core Portfolio, SageOne Small Cap Portfolio, and the last one, which is SageOne Large and Mid Cap Portfolio, which I will be taking you through over next 1 hour or so. So broadly, we offer it through both PMS and AIF structure. Currently, SageOne Core and SageOne Small Cap have both the options of PMS and AIF structure. SageOne Large and Mid Cap portfolio is only through PMS structure. So about SageOne Large and Mid Cap portfolio, SLMP we call it. SLMP is a specially curated bottoms-up portfolio of 18 to 25 quality businesses which are weighted by conviction. They are picked from the top 200 companies as defined by the market regulator MFI. So, which is, I think, top 100 companies are large cap and 100 to 200 companies are mid cap. Our aspiration is to outperform other available options in this category by trying to aim for an excess return of 3 to 5% over Nifty 50. If we are able to achieve that, that means I think we are doubling our portfolio in roughly around 4.5 years as such. Now, there are many ways to play Indian equities, but we believe that the bottoms-up stock picking becomes crucial in the investment objective of superior returns over market as such. We strive to deliver such superior returns in the large and mid-cap portfolio through SLMP. About myself, as Kamal highlighted, that I have around 2 decades of experience across financial markets. Started my career with JP Morgan on the investment banking side, then had a sell side experience in ICICI Securities for roughly 6 years or so. Then I had a proprietary stint where I used to manage money for a family office. Post that I joined Nuvama. I was part of sales. Plus, I used to manage direct equity portfolio of large family offices. So I have now close to 2 decades of experience. Have seen sectors in terms of whether it is banking, whether it is consumption. So have cross sectors experience as such. By qualification, I'm a CFA charter holder from US. Completed my MBA from Symbiosis and commerce graduate from St. Xavier's, Calcutta. Along with me, SLMP is managed by Satish Kazi, who brings about 10 years of experience. He has also extensive sell side plus buy side experience. Uh, what Kshitij, I think, and what we like about Kshitij is that he identifies mega trends quite early and gets the behavioral finance insights into the portfolio creation, which is, I feel, that the most important component of how portfolio should be created as such. In terms of qualification, he's also a CFA charter holder like me and has done his graduation from Mumbai. Uh, See, we too are the face, but SageOne, I think we operate through the same lens. And that lens has a guidance of Mr. Samit Vartak. So uh, I think we operate, although we are the fund managers, but I think the entire team contributes as such. As highlighted that all of us, so eight members team along with Samit, I think we are nine. So uh, we have a combined experience of more than 100 odd years. We discuss a lot of ideas together, and that is how we create all the portfolios of SageOne cross. So overall, I think this is about our team as such. Now, overall, our investment philosophy at SageOne, what we look for. See, first and foremost, I think across portfolios, what we look at is earnings growth is paramount for us because that is what drives business and valuation as such. Uh, at times and in bad times, earnings growth is the thing which gives that comfort of drawdowns as such. So, what are the key criteria what we look for in terms of creating a portfolio in SageOne is sustainable earnings growth. Now, this earnings growth may differ across portfolio. What is our required rate as such? Apart from that, better ROC, low leverage, predictable earnings are the key for us. One of the most important thing what we look for is on the operating matrix as well. We give a lot of weightage to operating matrix because there are at times there it may happen that the financial metrics are not coming in, but operating metrics are moving in the right direction. So and we have seen that the financial metrics comes with a lag. So we focus a lot on the operating metrics as well. Now, coming to the portfolio construct of SLMP as such, our portfolio is divided into two buckets: compounder bucket, which we call, which is growth bucket as such, and it constitutes around 70% of the portfolio. This is the bucket which consists of companies which are likely to compound earnings at around 16% for the foreseeable future and are assessed over our key framework of earnings growth, management quality, opportunity size, and operating metrics as I discussed earlier. The tactical or the value bucket is more of a of the consists of the companies where we see that there is some inefficiency in the valuation. Now that inefficiency can be because of certain industry-wide structure which is there, or there is a company which is going through a transition. So we kind of try to identify companies which is going through a change and which can lead to a high and predictable earnings growth. Thereby, market will reward in terms of higher valuation. Just going a bit deep into investment framework for the compounder bucket, we are looking for companies that have an earnings growth of around 16 to 18% as such, However, we prefer companies where the earnings growth is more predictable and the earnings is more sustainable as such. So, for example, there are companies where we look at operating matrix, as I discussed, and give a lot of weightage to that. There are companies in our portfolio where which are growing far ahead of competition. There in a sector where there is a slowdown as such. So overall, we prefer four key metrics where we analyze the company, where the opportunity size is there. Market share gain, we look at it from an operating matrix perspective. How is the management quality? And it should result in the earnings growth as such. So broadly, if we have to talk about, I think, and look at multi-baggers Indian market, I think these guys, these companies possess two characteristics overall. One is capital intensive, and the other is capital efficiency aspect of it. There are several companies which are very capital efficient as such, but if the growth or the scalability is not there, it will not lead to higher returns. So we look for companies where capital efficiency is high, and at the same time, the incremental growth or the growth aspects or the scalability of that growth is there. So these are the four characteristics where we uh, rank our companies and then we invest. Now, coming on to the tactical ideas or the value bucket. Now, by tactical ideas, we don't try to infer that it is a short-term kind of allocation as such. What we look for companies which are going through a transition. So, for example, in telecom space, for 10 years there was no money made, right? So suddenly there was an industry structure change where it became a 2.5 player kind of market, and there was significant amount of money which was made in both the stocks which were present. Obviously, one of the stock which is pure play telecom player benefited the most. So we look for these kind of industry structure change. Now there can be several examples which we look for and can be attributed for our tactical ideas. At times there have been like management change, or the company has been taken over by someone who is more aggressive. It leads to high growth, and at the same time the earnings profile of the company changes and it is more predictable, so market rewards in terms of high valuation as such. The other reasons can be new product or the category. Some product has become quite successful. There are a company coming out of big capex. Suddenly the cash flow profile of the company increases and the market rewards these kind of events. One thing which I wanted to highlight is that there can be an event where a tactical idea which we have bought for, let's say, 12 to 18 months kind of a time horizon, it fits into our compounder basket as well, because it possesses all the characteristics of what is needed to be part of uh, compounder basket. Coming on to the performance now, I just wanted to highlight that although it has been around uh, 2.5 years since we started managing this portfolio. So we started managing this portfolio from our prop money, which is April 2022. Public money we started taking from August 2023 as such. So we have outperformed all the major indices if you look at it. But we do know that 1.5 years or 2.5 years is too short a time period to pat our backs on this performance. Our endeavor is to learn through the process, whatever learnings which we have got over last 2.5 years, and to implement those so that alpha generation is more sustainable, and we are able to achieve that over a longer period of time. Coming to key attributes of SLMP. Now, as of now, our portfolio breakdown in terms of market capitalization is 70% is large cap and 29% is mid cap. Now, this is as per the regulator definition. We are not driven by this number. This number is more of an outcome or a byproduct, I would say. We are a bottoms up in terms of stock picking. So the resultant impact is this, and this 71-29 split can change by next year. We don't look at any particular number while designing a portfolio. This is more of an outcome. Our single largest exposure right now is around 6%, but in the past we have gone as high as 7 to 8% in terms of allocation as well. Obviously, in individual portfolio, that weightages may differ depending on the time they come in. And the smallest single stock exposure right now is around 3%. Right now, we have a holding of around 26 stocks, and the other financial metrics in terms of the capital employed and all is around 19%, and P ratio is 36 times. Now, when I look at SLMP versus benchmark as such in terms of sectoral allocation, now I'll just revisit again my point of how we look at stocks. Our criteria is simple in terms of earnings growth. So the allocation or the sectoral wise breakup is more of an outcome. We don't necessarily look at top down in terms of which sectors where we want to allocate as such. And in terms of allocating, we don't look at macro or the external environment which can favor one particular sector as such. So, for example, in terms of BFSI as well, when we look at the overall BFSI sector, it's quite huge in size, and there are different subsectors within BFSI as such as well. Right, whether it is banking, whether it is NBFCs, within NBFCs, there are niche NBFCs, there are non-lending financials, be it capital marketplace, be it insurance, be it, and within insurance, general insurance, life insurance. So, but if you look at it, our portfolio in terms of allocation, BFSI allocation may be around 37 odd percentage, but within that, it may vary as compared to the overall Nifty 50 as such. And so our point is that bottoms up approach helps in terms of alpha creation. Active portfolio is needed to create that alpha. Say similar is the case with consumer. Now, consumer companies, we have allocation of around 19 odd percentage, 19, 20 odd percentage. Despite overall consumption led slowdown, what we have seen over last year and a half, our portfolio companies have delivered significantly well ahead of what we require as a return. So we look at companies where there is sustainable growth and they and available at a fair to reasonable valuation as such. Now, when I compare our portfolio with the benchmark or the top 200 universe where we pick our stocks, it is generating higher ROE and is available at a valuation which is cheaper than the overall benchmark as such. The forecasted growth is also slightly on a higher side as compared to the benchmark. And when we look at the historical growth of earnings as well, it was far ahead of what other companies or the other benchmark has delivered as such. So just to conclude, overall, what we look for is consistent and predictable earnings growth, which should be driven by both operating metrics and financial metrics as such. There can be certain stocks which meet our criteria in terms of earnings growth as such, but if the valuation doesn't make sense or the moat of the company or the predictability of the earnings is not there beyond 2 years, we try to avoid those names overall. Yeah. So I think now I can take some questions, Kamal, or how do you want me to take it ahead?
Sure, Satish. This is like, as expected, you have kept your presentation very short, so we have sufficient time for Q&A. Foremost question, that I think anybody and everybody who would be keen to know from you from here onwards is that, first of all, why is it that SageOne has come into creating a product which is in mid and small cap space? Because SageOne has always been known for finding companies early and spotting those potential multi-baggers. And now, after having done really well in the mid and small cap space, if there is a large and mid portfolio, there could be, or there would be, some ideological, I would say, uh, thought behind creating such a portfolio. So what is it that I would like to first know that.
Yeah, so you are right in a way, Kamal. And see, as SageOne, we never wanted to, or we are never like looking for AUM game as such that we want to launch something in the large and mid cap portfolio. And we debated internally a lot. So when you look at when we were managing prop money, right, with this strategy, so we never launched it because we wanted to be sure that whether we can create that alpha for our investors or not. If we cannot create that, then there's no point of launching this product. So I think there were a lot of iterations, there were a lot of internal discussion, Sumit's guidance. Then we arrived at this process, and overall, more and more confident we got that can we create this 16 to 18% net of fees and expenses return for our investors. We should launch the product, otherwise not. Now, as I took you through the investment framework and the process, what we felt that through the combination of compounder basket and tactical basket, we should be able to generate that 16 to 18% kind of return for our investors. Now, if you look at last 15, 16 months or last 2.5 years, I think it has been, markets have seen a sharp run up, right? So this is not a not a right time to look at in terms of overall market or how the growth has been. But there are certain parameters which gives us confidence that our portfolio is time tested as such. So just to give you an example, we were doing this analysis today only. When we look at overall, then in terms of top 200 stocks, which is there in our universe, only 1 out of 26 stocks has fallen more than 20% as such in our portfolio, right? As compared to 90 out of 200, if I have to talk about. So obviously, see, there is some element of stability and less drawdown in in large and mid cap portfolio as such overall. I think we believe that with targeted growth rate of 16 to 18% or targeted return of 16 to 18%, our portfolio does provide a downside protection as well, because we are looking at portfolio companies from the same lens. The SageOne's lens talks about earnings growth, and in any downturn, earnings growth is the one which supports the valuation and the downside of the stock. So overall, if I have to answer, I think we are confident on the process, although it has taken time, I think, and we did a lot of iteration and debate internally. And the same question which you have asked, I think we asked internally ourselves whether we will be able to generate that alpha or not. The moment we became confident with our process, we launched the product. Having said that, we are in a learning mode, and we constantly try to learn through the process across our 3 portfolios. That is not particular to SageOne large and mid cap portfolio.
Sure, Satish. Moving on to next question, you have selected SageOne large and mid. Why is it that you particularly avoided small cap? You could have maybe launched a flexi cap or a multi cap strategy with less allocation towards small caps. Why is it that particularly, you have avoided using any small caps?
I think it would have I think overlap over uh, our SageOne core portfolio as such when we look at, let's say, and it would have been kind of a similar kind of a product. So I think our view was that whether there is a space uh, where I think mutual funds are not able to or generate that kind of alpha over Nifty as such. If you look at last 10-year rolling Nifty return as such, it has been around 13 and a half. If you look at, if you take the TRI, it will be 14 and a half. And mutual funds alpha overall has been to the tune of 1.5 to 2% only. Now, mutual funds uh, have a have become too big in the sense, and they have a portfolio of around 50 60 stocks. They are managing around 20,000 to 25,000 crore AUM in this bucket as such. So what we felt was that I think we can create a portfolio of 18 to 25 stocks where we can differentiate one through stock selection. And secondly, which is more important, is attribution or the allocation in terms of certain stocks. So our stocks, we don't mirror Nifty as such. If you look at our portfolio, the overlap between Nifty and our will be limited. And plus, even if there is a Nifty stock, the weightage in that in Nifty and our portfolio may slightly or will vastly differ as such. As I gave you an example of, let's say, BFSI. BFSI has 37% weight in our portfolio. In Nifty, it has around 32, 33% kind of weight. But the portfolio composition is totally different. We have a higher weightage on non-lending financials, which has done exceedingly well when you look at capital marketplace or whether it is general insurance. So these kind of plays. So it's more of an active layer what we have added, and it's a more concentrated portfolio, and we feel that this product can easily I think can target the segment which is looking for more large and mid cap universe as such.
No, sure, you're right in saying that most of the flexi cap or multi cap funds in the mutual fund space are like very high on assets and AUM, and then obviously their stock holdings are also too many, and that is and plus because of their size they ultimately end up investing in large and mid. So obviously your portfolio has a quite I would say good potential in terms of providing real value add to some of the clients who are exposed to some of those funds. Hence, there is
Sure.
definitely a position in investors' portfolio. Moving on to the subsequent question, when SageOne tries to identify a stock in large and mid, how does it view that? Do you view that with the growth lens, or you view that with value lens, in the sense that how are you, for example, very it's like within no time. Today, Zomato is also a large cap stock, though it got listed also at 70,000 crore valuation. Like from beginning itself, it was a large cap, but today it's like from moving to large to maybe giant cap. So and then Zomato is a company which earlier was not making profits and P's were very high. But so far whatever I have understood Sumit's style, he's value I would say cognizant. He's not value ignorant investor. That's how he has been able to identify some of the themes like specialty chemicals or some of the companies early, and has made given those have given multi-bagger returns. What is the ideology and philosophy you will follow in large and mid, when you will identify businesses?
Yeah, so as I highlighted, that earnings growth is key for us, I think, and growth is very important. Now, when you look at overall, if I have to talk about the compounder basket as such, if in India, I think there are companies which are growing at around 16 to 18% with all the characteristics what we want are never cheap. Right. So what we look for is, I think, these kind of companies, if they are available at a fair to reasonable valuation as such. Now, because we look at or we try to own around 20 to 25 names only, we do in-depth research in terms of how these companies can make money or how these companies can grow. The opportunity size of the matrix which I showed is very, very important for us. Now, there are portfolio companies right now where we believe that the scalability is there for next 10 years as well, right? You spoke about Zomato. I think food delivery, we have seen what has happened. Quick commerce is right now overall $5 billion kind of a market as such. I think if I combine all the three players, right? Yes, the competition is coming in, but this overall market size of this industry can be huge, right? There are many new use cases which are coming for quick commerce as such. So when we look at these kind of companies, we definitely look at a longer lens and the guys who are able to execute it well. Now we own a retailer where the valuations are very high, but when we look at the growth out there, I think it is upwards of 40-50% in terms of revenue growth, right? When the entire consumption market is slowing down, this guy is able to give you that kind of 40-50% kind of return. And when we look at the scalability of those companies, I think the newer formats, I think there are many levers of growth as such. So at times, uh, uh, we can is the historical valuation slightly expensive? Answer is yes. But when we look at the growth adjusted valuation, we still feel that there is still room to make that desired return of 18 to 20% for our portfolio stocks. So uh, to answer you, I think we are value cognizant in terms of when we look at stocks, but there are certain stocks which warrants a higher premium as such because the growth which they are delivering, and there are optionalities because, as I spoke about a retailer, I think they are creating many different formats as such. So how right now they may not be contributing anything, but if there is one success out there, the TAM increases meaningfully. We have seen that in Zomato 2 years back when they entered quick commerce, it was taken negatively. Now everyone is talking about quick commerce. Every day we see some or the other guy investing in quick commerce. So the opportunity size is the key out there. And within that, if the opportunity size is there, we would like to bet on the guy or the company who is very, very good on execution because retailing and all the and quick commerce, any business is not that easy in India, and the market leader makes disproportionate share of the profit pool as such. So we try to bet on those kind of companies.
Sure, Satish. What is the view, with regards to your target universe of large and mid-cap companies on IT sector?
See, overall, now IT sector, if you look at last 12 to 15 months, has witnessed a slowdown because of what was happening in US. Interest rates were going up, so IT spends were cut. Uh, Even now, when we look at it, this quarter number was slightly, I think, in line as such. Now there is expectation that given that proposed tax cut which will happen in US, it may lead to extra IT spending and such. Uh, we remain cognizant of the growth drivers, but at the same time, the run-up what we have seen in IT space as such is totally factoring in those kind of positivity until and unless the growth surprises on the upside. We do have exposure to IT space as well. I think we have exposure to one of the fastest growing IT names, and it has done exceedingly well for us. The challenge is on the valuation side as such, it has gone to upwards of 40x, 40 plus x on forward earnings as such. So that limits our optimism as such. But if there is any change or any view we have in terms of whether these earnings can surprise us on the positive side, we will be more constructive as such. As of now, we are equal weight kind of allocation in terms of IT.
Sure. While we discuss with our clients about SageOne's large cap portfolio, while the fitment, positioning, target universe of stocks as shown in the fact sheet, as well as the ideology and, the track record of SageOne, all these things are absolutely, I would say, positive. But one factor where, investors ultimately do not get clear answer is that they feel that this strategy is not going to be directly managed by Samit, and everything kind of boils down to the fact that who is the ultimately fund manager. That's where today we thought of doing this webinar with you, which is absolutely trying to demystify this doubt. But having said that, what is the role that Samit plays in the overall investment decision making in your PMS? And if there is a full process and full investment committee, please maybe explain this aspect.
Yeah, so it's a fair question, and we have faced this question many times, and that gives us see, overall we follow an investment committee process, right, across funds. So wherever we are buying, we follow that, and we discuss within our team. So as I said, eight of us plus Summit, so we are 9 of us. We discuss it extensively. And with respect to SageOne Large and Mid-Cap Fund, every idea is screened through Samit as such. And once he is convinced, I think then only we go ahead. So there is a proper oversight, if I have to say, of Samit in managing this fund. In terms of looking at stocks, those things are obviously done by us. And we take it through Samit and the entire team as such. But yeah, and as and when I think we need any help in terms of guidance and all, we do sound it to Samit and take that. And for that matter, entire team. So
Sure, Satish. What are your, I would say, expectations from this portfolio in terms of growth of assets, or maybe the targeted returns you have highlighted 16 to 18% in longer term. But as a man behind the portfolio, at the end of the day, you are the ones who's going to be responsible for the growth of assets as well as the outperformance it delivers. Your team and your process and your company is going to back it up. So what are your personal, I would say, expectations from here onwards in this regards?
So personal expectation in terms of AUM growth for this fund, or
yeah, overall in terms of obviously today SageOne Large and Mid Cap is close to 100 crores. So it's like relatively a smaller I would say basket, right? In the overall SageOne's portfolio, but you have taken the responsibility of growing this up. So obviously you will have some targets, some foresight ahead of you.
Yeah, so it's always there. So I think first year we wanted to I think slowly perform. Now the target is to perform and scale it up as well. I think this is how I think the perfect J curve we would like to take, but we will always be cognizant of the fact as such in terms of how much money we want to manage in this portfolio. So just to give you an example that large and mid cap stocks have kind of decent amount of liquidity as such, and liquidity is one of the criterias what we look at in terms of when we buy a stock. So there can be certain stocks which we have avoided because the required liquidity was not there. Although right now we are managing 100 odd crores, that liquidity is easily possible in any stock. But when we are managing even now, we are looking at it that let's assume that we are managing around 2000 odd crores, and the criteria of liquidity should be in terms of whether we'll be able to buy 4% allocation easily from the market. So aspiration is to reach around 2000 odd crores over next few years. But again, number will be a byproduct as such. We want to continuously improve our process as such, and we feel that the market is so large that eventually if we are able to perform, the numbers will come. So SageOne as such, our philosophy is not driven by numbers. Our philosophy will be more on the process, how we can improve the process, and AUM will follow.
Sure. Generally speaking, when anybody would maybe want to take a decision of investing into large and mid cap side, and then he tries to evaluate variety of products, and he reaches say SageOne Large and Mid, he will be quite excited. But then before cutting the check or before finalizing, one question will hit him that why I am investing in why I am investing in large and mid cap category. Maybe because I am wanting to be relatively more risk cognizant when I'm parking this money or investing this money versus maybe a multi-cap fund or a maybe flexi mid and small cap fund. At that juncture, if investor kind of doesn't see that whenever in the last say 2 years of your track record, markets have shown a drawdown, has your portfolio also shown less drawdown versus say any other flexi cap portfolio or a small and mid cap portfolio? Because it's like a comparative analysis, if I recall, why I'm asking this question is because few of our clients, who kind of have seen October numbers, they kind of go back and kind of introspect that why am I investing in large and mid cap category when SageOne large and mid cap or any other large and mid cap stock, mutual fund has fallen same like your SageOne core. So there is like, is there a considerable data since last 2 years for your fund or for, I would say, any other fund, whereby we can say that yes, if I am settling for 16 to 18% return because I am kind of keeping my expectations high on less volatility, on less beta, on less standard deviation, right? Does data also prove this?
So, as I said that we did this analysis today that out of top 200 stocks, in terms of the stocks which have fallen more than 20%, we have only one stock. Okay. If I do another analysis of out of 200 stocks, there have been 36 stocks which has fallen less than 10%. Right. Out of that, so 35 stocks, we own 9 of them. Right. So, and in terms of drawdown as such, I think our drawdown from peak is similar to what Nifty has witnessed. But the kind of return I think our portfolio has seen, right, in last 1 year, I think that kind of similar fall to Nifty, I think is acceptable in the sense. Now, if I look at the numbers as such, I think as I said that we are driven more by numbers. BSE 200 EBITDA growth was somewhere around, or earnings growth was somewhere around 5% for Q2 FY25. Our portfolio EBITDA growth was somewhere around 9.5 to 10%, even in this quarter where we have seen that the earnings has surprised or shocked meaningfully to all the I think to the entire fraternity as such. So overall, I think this point makes or gives us comfort that our portfolio is on the right track as such, and wherever we feel that something is gone wrong in our portfolio in terms of whether a particular stock, we take that corrective action. Now the history is too short in the sense to judge on the drawdown as well, because this is the first drawdown which we have seen since we started managing money, right? So if you have to ask me about the mistakes what we have done, I think last 18 months people will not be able to point out which stock has gone right, because one way market was going up. So we take comfort from how our earnings has grown, we take comfort from how our portfolio has done, both on the operating side and on the financial side. So, so that is there. And on the drawdown side, if I have to tell you, I think from the recent peak, it is down similar to Nifty. But we have many stocks which have gone up meaningfully. So they have also corrected, but the numbers or the financials of those companies are still intact.
So what is your personal skin in the game in this portfolio, if any?
Yeah, so I have also invested in this portfolio, and a certain amount of my compensation also goes to this portfolio. I think for both Kshitij and me, I think that's the case.
Sure, Satish, I think it has been really pleasure conversing with you. I have no more questions. This is like, 45 minutes of short webinar that we thought that we'll do with you to particularly understand your positioning of the product. And I think it has been very clear. Simple products are the ones that scale eventually over longer term in terms of performance, and you are performance driven. And I know, you guys believe in pulling rather than pushing, which is absolutely how we also operate. Thank you everyone for joining today. If you guys, want to do any other webinar or, with us, to continue, maybe such conversation, we are happy to connect with you, because we find there's a lot of intelligence behind SageOne's decisions, and your reports and your newsletters are all quite insightful. And I'm happy to, involve with you and maybe discuss and decide.
So,
Thank you so much.
Sure. My pleasure, Kamal, and thanks interacting with you.
My pleasure is equally mine. Thank you. Thank you everyone for joining. Thank you.